Can you show a volatility skew example? Have you ever wondered how traders gauge market sentiment through options? One key concept that plays a significant role is volatility skew. Let's break it down and look at a practical example to clarify this idea. Volatility skew refers to the variation in implied volatility across options with different strike prices but the same expiration date. This means that the market's expectation of price movement differs depending on whether the option is for a lower or higher strike price. Imagine a stock trading at $100. You check the implied volatility for options with strike prices at $90, $100, and $110. If the implied volatility for the $90 put option is higher than that for the $110 call option, you are witnessing a classic example of volatility skew. This indicates that traders expect more risk or movement to the downside, leading to higher demand for downside protection. This pattern is quite common in stock options. It often suggests that traders are more concerned about a significant drop in stock prices rather than a substantial increase. As a result, they tend to bid up the price of downside puts, which raises their implied volatility compared to upside calls. To visualize this, picture a graph where the x-axis represents strike prices and the y-axis represents implied volatility. Typically, this curve slopes downward as you move to higher strike prices, showing that lower strike options have higher implied volatility. Let's consider a specific example. Suppose XYZ stock is trading at $50. The implied volatility for the $45 put option might be 30%, while the implied volatility for the $50 call option could be 25%. The $45 put has a higher implied volatility compared to the $55 call, illustrating the volatility skew. Traders often use this skew to assess market sentiment. If downside puts show much higher implied volatility than upside calls, it indicates fear among investors. Conversely, if the skew is less pronounced or even reversed, it may signal optimism in the market. Understanding volatility skew is essential for options traders. It helps them make informed decisions about which options to buy or sell. For instance, if the skew is steep, a trader might consider selling expensive downside puts if they believe the market is overly fearful. Alternatively, they might buy upside calls if they think the market is underestimating the chances of a rally. In summary, volatility skew is a vital concept in options trading. It reveals not only expected price movements but also the overall mood of the market. By recognizing and interpreting skew patterns, traders can adjust their strategies to align with current market conditions.